Good day, everyone. Thanks for joining me. This is Denise Appleby, here to talk about this very hot topic. As I'm sure everyone now knows, because I've been getting the emails, the proposed regulations were issued earlier this year interpreting the Secure Act and changed some of what we thought applied. So that's one of the reasons why we're here today, because I got requests, I usually take requests on what topics I should cover during my quarterly webinars, and this one topped the list. The rules might change. That's the first thing I wanted to make sure we're aware of. And as I change anything that applies to this presentation, I'll send you an updated version of the PDF file that I sent you. And you're actually going to be getting an updated version this afternoon, because my assistant made some edits to typos and sent that to me after I sent out the PDF to you. So once you get the revised version, please discard the old one and use the one that I sent you today. So there were a lot that was covered under the proposed regulations, but we only have an hour. So I trimmed it down to the topics that I've been getting the questions on the most. What is this about the 10-year rule, Denise? Because you told me one thing, now I'm hearing something else, and what do I tell my clients? So hopefully I'll answer those questions for you today. And as we go along, please use the chat feature to submit any questions that you have. If I don't get to those questions by the end of the session, I promise I'll respond via email. So we're going to be looking at the 10-year rule for beneficiaries. New rollover rules for certain spouse beneficiaries. That one definitely was one of the surprises. And the good news, new waiver rule for certain missed RMDs. So I'm not going to be covering trust beneficiary rules today. Usually, when I get a question about trust beneficiary, depending on what it is, I like to refer it to an attorney who I know is proficient in that area, because the rules are so complex. And even though some people feel that they have been simplified under these proposed regulations, it seems to me that they have gotten more complicated. And what I don't want to do is give you a response that's going to cause you to give your client an inaccurate response. So I'm sure you would appreciate the fact that I'm not a trust expert. And if it gets to that level where it requires a trust expert, I recommend a trust expert, preferably an attorney. And of course, defined benefit pension plans, the rules are different. So just bear in mind that what I talk about today do not apply to defined benefit pension plans, just defined contribution plans like 401ks, 403bs, and profit sharing plans. And an important reminder, because I always get this question, well, Denise, you never talk about Roth IRAs. Are they covered under these rules? Absolutely they are. But bear in mind that for Roth IRAs, there's no required minimum distribution for the Roth IRA owner. How does that affect what we're talking about? Well, it means that when someone inherits a Roth IRA, the options that are available to them are the same, regardless of what age the Roth IRA owner dies. And that's different for traditional IRAs, because for traditional IRAs, we have to ask the question, what's the date of birth, what's the date of death? And the objective then is to determine whether the account owner died before the required beginning date, because the options are different. So just to go back a little bit, you remember that the Secure Act was signed into law on December 20th, 2019, and became effective January 1, 2020. And I sent you a whole lot of documents, including sample letters that you could share with your clients, and held webinars and told you certain things that now that the proposed regulations have been issued, I'm going to have to go back and correct that. But the question then becomes, how do we move forward, right? And part of that is to revise some of those communications that I shared with you so that you can in turn share them with your clients. The Secure Act repealed age limitation for traditional IRA contributions. We're not going to be talking about that today. It also changed the required beginning date. We're going to touch on that today because it's important for determining whether or not the account owner died before the required beginning date. And of course, the hot topic, the distribution options for beneficiaries. So as you know, when we have new laws, the IRS is responsible for explaining to us what those laws really mean. But of course, before that, we usually take it up on ourselves to try to figure it out. And that's what many of us did, including financial institutions, attorneys, and other professionals. But then when the Secure Act was signed into law, when the proposed regulations were published on February 24th, it created quite a tizzy. And that's primarily because we have been telling individuals, if you are a plain designated beneficiary, you're subject to the 10-year rule. And what that means is you don't have to take any distributions from year 1 through 9, as long as you take a full distribution of what remains of the account at the end of year 10. Now, you're going to find out as we go along that that's only partially true, right? And so the question for us becomes, well, who is it true for? And who is it not true for? A question that I get is, well, Denise, these are proposed regulations. Can we rely on them? Yeah. When proposed regulations are issued, those are all we have to rely on until final regulations and additional guidance are issued. So as far as we're concerned here today, this is the law of the land until we get final regulations. And then it depends on whether or not those final regulations changes anything. So one of the biggest things that came out of the proposed regulations is the at least as rapidly rule continues to apply. Now, this is a holdover from the existing regulations. When I say existing regulations, I'm talking about those final regulations that went into effect in 2002, right? Before the Secure Act. Now, the proposed regulation says, just like it applied before the Secure Act, if a retirement account owner died on or after the required beginning date, they were supposed to be in RMD status. And that means their beneficiary must continue taking RMDs at a pace that is at least as rapidly as the pace at which the owner was taking distributions. So what that means is, even for a plain designated beneficiary who inherited a retirement account from someone who died on or after the required beginning date, and they're subject to the 10-year rule, they still have to take annual RMDs. I'll be covering some examples that shows how that works. One of the good things that came out of the proposed regulations is we got answers to certain questions like who is a minor and what does no more than 10 years younger really mean. Now, I know that you guys get a lot of questions about beneficiary options. When we do get those questions when you get those questions from clients, in order to even begin to answer those questions, you have to ask certain questions like, okay, so you inherited an IRA. What was the date of birth of the IRA owner? What was the date of death of the IRA owner? So we can tell whether or not the IRA owner died before the required beginning date, right? We also want to know, did the IRA owner die before 2020? Because a different set of rules apply. And we also want to know, is the beneficiary a non-designated beneficiary, a designated beneficiary, or an eligible designated beneficiary? And if you have never attended one of my beneficiary sessions, right now you're probably thinking, well, what's the difference between all of those? Don't worry, I'm going to be covering that. I thought it makes sense to at least highlight the Pre-Secure Act rules because they still apply to some clients. If a client walks into your office and says, and the profile shows that the IRA owner died before 2020, then we know that the old required beginning date rule applies. If the beneficiary also died before 2020, then we know that the Pre-Secure Act rules apply. So one of the big things that came out of the Secure Act is that the stretch IRA is dead for most beneficiaries. But that's true only if the account was inherited after 2019. So you're still going to have some clients who you are required to apply the pre-secure stretch distribution rules to, because both the retirement account owner and the beneficiary died before 2020. So what's the required beginning date then? It depends on when the IRA owner reached age 70 and a half. For an IRA owner who reached age 70 and a half before 2020, the required beginning date is April 1 of the year that follows the year in which the individual reaches age 70 and a half. If the IRA owner reached age 70 and a half after 2019, then the required beginning date is April 1 of the year that follows the year in which the individual reached age 72. And I'm going to be saying IRA a lot, but when I use the term IRA, unless a specific rule does not apply to an employer plan, such as a 401k, I'm using it as an all-inclusive term to include IRAs and employer-sponsored retirement plans. Now, for a participant, this is one of the exceptions. If an individual is still employed and is a participant in an employer-sponsored retirement plan, such as a qualified plan, and if the terms of a plan allow, then the required beginning date can be deferred past age 72 until April 1 of the year that follows the year in which the individual retires. So we always want to ask the client, what type of account do you have? And if they say it's a 401k, for instance, the question becomes whether or not, under the terms of the plan, they are permitted to defer starting RMDs past age 72. Because even though the regulations do allow that, it's not always the case where you find a plan that permits it. So we always want to double check to be sure. And it's also important for individuals who run their own businesses, because they're considered 5% owners, and 5% owners, which are individuals who owns more than 5% of the business that sponsors a retirement plan, are not permitted to defer starting RMDs past age 72. Old Pre-Secure Act rules. Who's the beneficiary? Any party that inherits an IRA is the beneficiary, and usually that's the party that's named on the beneficiary form at the time of the retirement account owner's death and survives the retirement account owner. But you will have cases where the terms of an IRA agreement will determine who the beneficiary is. For instance, if the beneficiary does not survive the IRA owner, or if the beneficiary, primary and contingent beneficiaries, properly disclaim those assets, then if there's no beneficiary that survives the account owner, we determine who the beneficiary is based on the default provisions of the IRA agreement. Now, when a party is a beneficiary, they can also be a designated or a non-designated beneficiary. A party is a designated beneficiary if they're a person. And some trust, if the trust meets certain requirements, is also considered a designated beneficiary, generally allowing the life expectancy of the oldest beneficiary of the trust to be used for RMD purposes. Now, we determine whether or not an IRA has a designated beneficiary by September 30th of the year that follows the year in which the IRA owner died. A non-designated beneficiary is a non-person, such as a charity or an estate. Now, this table summarizes the distribution options for someone who inherits a retirement account before 2020. So I'll quickly summarize that. If the owner died before the required beginning date and the beneficiary is a designated beneficiary, it's the 5-year rule or over the beneficiary's life expectancy. If the beneficiary is a non-designated beneficiary, it's the 5-year rule. And if the owner died on or after the required beginning date, it's over the longer of the decedent's life expectancy or the beneficiary's remaining life expectancy. And if the beneficiary is a non-designated beneficiary, then it's over the decedent's remaining life expectancy. For a spouse beneficiary, where the account owner died before the required beginning date and the spouse is subject to the life expectancy rule, then distributions need not begin until the later of December 31st of the year that follows the year in which the individual reaches age 70 and a half, because we're talking pre-secure, right? Or the December 31st of the following year. In all other cases where the life expectancy rule applies, distributions must begin by December 31st of the year following the year of the account owner's death. So I just talked about the fact that whether or not an account has a designated beneficiary is determined as of September 30th of the year following the year of death. So you want to look at who is the beneficiary that remains on the account as of September 30th of the year following the year of death. This is important when an account has multiple beneficiaries, right? You ignore for this purpose anyone who dies before the account owner, anyone who takes a full distribution of their share by September 30th of the year following the year of death, or any beneficiary that properly disclaims their share of the account by September 30th of the year following the year of death. Now, this rule still applies under the Secure Act and under the proposed regulations. So what this means is that when a client tells you that they inherit a retirement account, you want to make sure you ask the question, were you the only primary beneficiary in the account? Because whether the answer is yes or no could change the distribution options that are available to that beneficiary. Now, I know that many IRA custodians are calculating RMDs for inherited accounts. And what I'm finding is that they're not asking this question. And the result of that is some of the calculations that they're doing for these inherited accounts are just plain wrong. Because in some cases where an IRA owner died before 2020, for instance, and there are multiple designated beneficiaries, it is a life expectancy of the oldest beneficiary that is used. And if separate accounting, where the assets were split into separate accounts by December 30th of the year following the year of death, I find that some of these custodians are using the life expectancy of a very young beneficiary, which means that they're going to have RMD shortfalls, less than the RMD that should be taken is being distributed. So if you're working with a custodian that does RMD calculation, that's good. It's a nice benefit that they provide, but always double check to make sure that they are considering all the factors that contributed to who is really the beneficiary whose age should be used for calculating RMD purposes. So the Secure Act rule applies to anyone who reached age 70 and a half before 2019, beneficiaries who inherit retirement IRAs after 2019, and successor beneficiaries who inherited IRAs after 2019. I think I went back a slide. I'm sorry about that. The Secure Act, I'm sorry. The Secure Act applies to IRA owners who reach age 70 and a half after 2019. It's been a long 2 nights. I've been doing all-nighters for the past 2 nights, so bear with me here. And beneficiaries who inherit retirement accounts after 2019. So this is where when the client comes in to see you and say, I inherited a retirement account, you want to find out, did you inherit that retirement account after 2019 or not? Because that determines whether or not the Secure Act rule applies to that beneficiary, right? If you say, for instance, someone's transferring in a beneficiary IRA to you, and you want to determine which of the distribution options apply to your client, you might find out that your client that's transferring in that beneficiary IRA did in fact inherit that account before 2020, in which case you want to look at the pre-Secure Act rules to determine which options are available to your client as far as distributions. But if that client inherited the account after 2019, then we know that we have to apply the Secure Act rules. Now, the Secure Act introduced a new category of beneficiary called the eligible designated beneficiary, which is the surviving spouse of the account owner, a minor child of the account owner who has not reached the age of 21, beneficiary who's disabled, chronically ill, or does not fall under any of the above, but is not more than 10 years younger than the account owner. And these are determined at the time of the IRA owner's death. So if a beneficiary comes in to see you and you ask, are you disabled or chronically ill? And they say yes, the follow-up question has to be yes, but were you disabled or chronically ill at the time of the IRA owner's death? Because if you became disabled or chronically ill after that, then you don't count as an eligible designated beneficiary, because your status as an eligible designated beneficiary is determined at the time of the IRA owner's death. So how come we were so confused about that 10-year rule? This is an excerpt from the Secure Act, and you'll see here it says clearly that under the 10-year rule, distributions are optional from year 1 through 9. And guess what? If you are not an eligible designated beneficiary, but a plain designated beneficiary, this rule applies to you regardless of the age of the IRA owner at death. Seems pretty simple enough, right? Well, the IRS agreed, because in publication 590, they pretty much said the same thing. So what we have been telling individuals, based on how the Secure Act was written and based on the IRS publication 590, which of course is not official guidance, we have been saying to individuals, if you have a client who's not an eligible designated beneficiary and they inherited a retirement account after 2019, then it's just a straight 10-year rule. And that means that from year 1 through 9, they can decide whether or not to take distributions as long as they fully distribute the account by the end of year 10. Now, that created an issue, though, because we have beneficiaries who are designated beneficiaries that didn't take distributions in 2021 for accounts that they inherited in 2020, because we were telling them that you're not supposed to take an RMD unless if you want to take a distribution, you can, but there's no required minimum distribution. But that's true only if the retirement account owner died before the required beginning date. So I won't spend too much time on this, because I get into this later on when we look at the provisions under the proposed regulations, which is really what we want to talk about here today, right? So forget the misinterpretation of the Secure Act. Let's talk about what the proposed regulations say, because that is what we have to rely on as we communicate with clients. Part of what the Secure Act answered is, who is a minor? We know that different states have different definitions of who is a minor. And so that's one of the questions that we were confused about. What should we be telling clients? The proposed regulations luckily answered that question. We're just going to use a blanket age. A minor is any beneficiary that is a child of the account owner. You can't use a grandchild or anyone else. It has to be a child of the account owner who has not yet reached the age of 21. They also provide an explanation of who is disabled. And I included some explanations here, but because I know we're really here for the 10-year rule and an explanation of the distribution options, I included this just so that you can look at it later on. But here's what I'm offering. If you get a question about who is considered disabled, who is considered chronically ill, just send me an email and I'll write you a full detailed explanation of who is considered disabled or chronically ill. But considering that we have only an hour, I want to get to the real interesting stuff. But here's a tidbit. If someone is classified as disabled by Social Security Department, then they're considered disabled for purposes of determining who is a beneficiary. I also included an explanation of who is considered chronically ill and some documentation requirements, because part of what the proposed regulations say is that certain documentation has to be provided to the IRA custodian by October 31st of the year following the year of death in order for someone to be classified as disabled or chronically ill, which really doesn't make sense to me. If you are, you are. It shouldn't matter when the documentation is provided to the IRA custodian. That's one of the rules that is being challenged. So hopefully they'll change it in the final regulations. Here's something interesting though, not more than 10 years younger. Who is considered not more than 10 years younger? We thought, based on previous regulations and the tax code, that not more than 10 years younger means that if someone was born at any time during a calendar year, to determine if someone's not more than 10 years younger, you look at that on a calendar year basis. But the proposed regulations say no, you have to look at the actual date of birth. For instance, if Susie's date of birth is October 1st, 1953, Susie's beneficiary is not more than 10 years younger if the beneficiary was born on or before October 1st, 1963. Now, most of the RMD software that I use to calculate beneficiary RMDs, I've taken the other position. Why am I telling you this? Because if you are using any of those software to calculate beneficiary distributions, and the age is close like this, so you're not sure whether it's more than 10 years younger or not, you have to check to see whether or not that software is looking at it on a full calendar year basis, or is that software using the true date of birth of the account owner and the beneficiary? Because if they're not, then the results might be incorrect, and you might be telling someone that they are an eligible designated beneficiary when they're not. Right? So we always want to make sure we get that right, because now the distribution options are so strict that we want to make sure that those who are eligible designated beneficiaries and qualify to take distributions over their life expectancy do get that benefit. So let's look at some of the distribution options under the proposed regulations. I talked about the at least as rapidly rule. And my experience is that many of us in the industry feels that the IRS got this wrong. I'm not sure if they did. We'll see when they issued the final regulations. But if you do look at the existing regulations, and if you do look at the language in the Secure Act, except for the fact that they say that the 10-year rule applies regardless of when the account owner died, you could see where it makes sense that the at least as rapidly rule, which requires any beneficiary, whether it's a designated beneficiary or an eligible designated beneficiary, to continue taking distributions that were being taken by the decedent. Now, consider that the eligible designated beneficiary category is carved out so that those beneficiaries get benefits that are not available to individuals who don't qualify to be eligible designated beneficiary. Why would they make it so that the 10-year rule for a designated beneficiary is more favorable to a designated beneficiary than it is to an eligible designated beneficiary? So from that perspective, it does make sense. But for you and I, it really doesn't matter why or what makes sense. For us, what matters is what are the rules? What do the proposed regulations say? And what should we be telling clients? Now, before I get into the RMD rules for beneficiaries, I just want to remind you that after we ask the client what is the date of birth and date of death of the retirement account owner, if it is determined that the retirement account owner died on or after the required beginning date, the next question has to be, did they take their RMD for the year of death? Because if they didn't, it has to be taken by the beneficiary by December 31st of the year of death. That's a general rule, but I'll talk about an exception later, another bonus under the proposed regulations. So that RMD is going to be calculated as if the IRA owner lived through to the end of the year and is reported under the beneficiary social security number. So the beneficiary is going to include that amount in income, right? So you pretend that the account owner lived through to the end of the year, but the amount is transferred to a beneficiary IRA for the beneficiary, and the beneficiary then takes that distribution. If the beneficiary doesn't take it by the deadline, then the beneficiary is going to owe the IRS a 50% excise tax on any amount that should have been taken, but's not taken by the deadline. Now, you know I love charts, and this is a summary of the distribution options based on the proposed regulations. Now, I added some terminology that's really mine: straight 5-year rule, straight 10-year rule, and the combined rule. And when I talk about the straight 5-year rule, I mean that distributions are optional from year 1 through 4, but the account must be fully distributed by the end of year 5. And for the 10-year rule, distributions are optional from years 1 through 9, but the account must be fully distributed by the end of year 10. The straight 5-year rule and the straight distribution rule only applies when the account owner dies before the required beginning date. So now you see why it's important for us to determine whether or not the retirement account owner died before the required beginning date, regardless of who the beneficiary is, right? Because you'll see here, if it's a designated beneficiary and the account owner died before the required beginning date, then they have, I'm sorry, if it's a designated beneficiary and the retirement account owner died before the required beginning date, if we're talking about an account that was inherited after 2019, then it's the straight 10-year rule. Whereas if the account owner died on or after the required beginning date, I'm on the right side of the chart here. The left-hand side of the chart is the Pre-Secure Act rules, which we already covered. So move over with me under the column that says owner dies after 12/31/2019. And you'll see here, for death before the required beginning date, if it's a designated beneficiary, it's a straight 10-year rule. Whereas if death occurred on or after the required beginning date, now we have a combined rule where the distribution must be taken over the applicable life expectancy, but the distribution period cannot be more than 10 years. I'll cover it in some examples later on. For an eligible designated beneficiary, they have two options if the account owner died before the required beginning date: the life expectancy rule or the straight 10-year rule. If the account owner died on or after the required beginning date, then it's a 10-year rule combined with the life expectancy rule. And for a non-designated beneficiary, that has not changed from the Pre-Secure Act rule. It's still the straight 5-year rule if the account owner died before the required beginning date or over the decedent's remaining life expectancy. That seems simple enough, right? But when you read the proposed regulations, they include some examples that prevents distribution from even getting to the 10-year period in some cases. Part of what they're looking at is, well, what is the applicable life expectancy that applies to that particular beneficiary? And in some cases, if that life expectancy ends earlier than 10 years, then guess what? The account has to be fully distributed before the end of the 10-year period, because it has to be distributed by the end of the applicable life expectancy period. So now, not only do we have to determine whether or not a beneficiary is an eligible designated beneficiary and all the other factors that we talked about, we have to determine if the applicable life expectancy is shorter than the 10-year period, because in some cases it might mean fully distributing the account before the end of the 10-year period. For example, consider that if the beneficiary is a designated beneficiary, we know that if death occurred before the required beginning date, distributions are optional from years 1 through 9. So there's really no RMDs until the end of year 10. At the end of year 10, they have to fully distribute the account. But if the account owner died on or after the required beginning date, then a full distribution is required by the earlier of the end of the 10-year period that follows the year of the owner's death, or the end of the applicable life expectancy, where that life expectancy would be the longer of the life expectancy of the decedent or the life expectancy of the beneficiary. And in this case, life expectancy is non-recalculated, meaning that once we determine the life expectancy in the year following the year of death, if the life expectancy of the beneficiary is used, or the year of death, if the life expectancy of the decedent is used, then we subtract 1 for each subsequent year to determine what life expectancy should be used for each subsequent year. I know some of you are nodding your head right now because I get that question for you a lot, where you're looking at the single life expectancy table and you're thinking, well, this person is a certain age. It doesn't match up to the life expectancy factor that a software produces. And that's because when you're using except for when you're using the life expectancy of a spouse beneficiary, it's non-recalculated, which means you have to go back to the determination year and subtract 1 for each subsequent year. For an eligible designated beneficiary, here's something that the proposed regulations clarified, which is really a carryover from the existing regulations. The beneficiary can choose between the life expectancy rule or the 10-year rule. So now you, as the advisor, when you're dealing with an eligible designated beneficiary and you determine that they inherited the account from someone who died before the required beginning date, now the next step is to determine, well, what are the terms under the governing plan document? Does it allow them to choose, or does it default, right? The default is usually the life expectancy option. But some plan documents do default to the 10-year rule, used to be the 5-year rule before the Secure Act. And this is especially important with qualified plans like 401k plans. In my experience, they're more likely to default to the 10-year rule. And so the question becomes, what if you're working with a beneficiary that inherits a 401k account, for instance, and the 401k defaults to the 10-year rule, and you're thinking, well, I want my beneficiary to be able to use the life expectancy rule. What do you do then? Then you do a direct rollover of those assets to a beneficiary IRA by December 31st of the year following the year of death, so that they can use the life expectancy option. Now, where the account owner dies on or after the required beginning date, a full distribution must be taken by the end of the applicable life expectancy, where distributions are made over the longer of the life expectancy of the decedent or the life expectancy of the beneficiary. And again, life expectancy is non-recalculated, and distributions must begin by December 31st of the year following the year of death. Now, there's a provision in there for beneficiaries that are older than the retirement account owner, which requires the distributions to be completed within even a shorter period. So it seems that this is designed so that it's at least beneficial to beneficiaries that are older than the retirement account owner. Lots of rules to think about, right? If the beneficiary is the minor child of the account owner, and the account owner died before the required beginning date, they too have the options of the 10-year rule or the life expectancy rule, except that if they choose a life expectancy rule, distributions are made over the minor child's life expectancy, but it's switched to the 10-year rule when the minor child dies or reaches age 21. And at that point, it's the straight 10-year rule. But if the account owner died on or after the required beginning date, then there's a life expectancy distribution. But when the child reaches age 21 or dies, then it gets switched to the 10-year rule, except that in that case, it's not the straight 10-year rule. It's a continuation of annual distributions. And for non-designated beneficiaries, again, everything is still the same. The 5-year rule applies when the owner dies before the required beginning date. and the life expectancy of the decedent, the remaining life expectancy of the decedent is used when the account owner dies on or after the required beginning date. Now, I just talked about this before, where if the account owner dies before the required beginning date, then we want to check to see if there's a default provision in the agreement. Now, for IRAs, for 401k plans, when a participant completes a beneficiary form or distribution request form, they're usually required to make an election. Am I choosing the life expectancy rule or the 10-year rule, or the plan document might default? It's much harder to detect in IRAs because usually IRAs do not require a written election. So we have to be even more careful when it comes to IRAs because the option is buried within the terms of the IRA agreement. So now when the client comes in to see you and you find out that they inherit an IRA from someone who died before the required beginning date, then part of what you want to do is ask for a copy of the IRA agreement or call the IRA custodian to see whether or not your client is eligible to use the life expectancy option if your client's an eligible designated beneficiary and want to use the life expectancy option. Now, assume that your client inherited an account from someone who died before the required beginning date, and they're subject to the 10-year rule. Part of what you're going to be expected in most cases to help them decide is, well, should I wait until the end of the 10-year period, or should I spread distributions over the 10-year period? And of course, that is a tax question, right? If it's a Roth IRA, it's an easy answer because we know that at the end of the 10-year period, everything's going to be tax-free. But if it's a traditional IRA, then any amount that's attributed to pre-tax assets are going to be included in income. And so the question becomes, is it more beneficial for that client to wait until the end of the 10-year period? I use this example of someone inheriting $250,000, and you'll see if they wait until the end of the 10-year period using a very conservative rate of 5%, then at the end of the 10-year period, you're going to have $387,000 to distribute. Would that be better than them, say, spreading it out evenly over 10 years, taking into consideration earnings? That's a tax question, and that's where a partnership with the client's CPA would come in handy, because they're going to look at the client's tax profile and determine, well, which one is going to produce the least amount of income tax for this particular client, because it's not about those distributions, right? It's also about whether or not the client has other income that could affect how much they're required to include in income for the year. And of course, other issues and matters that are related to taxes. I thought it makes sense to include an example here that shows the at least as rapidly rule. Sandy died this year at age 75. Her beneficiary is her 64-year-old brother, Larry. Larry is not disabled or chronically ill. Therefore, he is a designated beneficiary. Sandy's remaining life expectancy is 14.8 years. Larry's life expectancy is 22.9 years. Now, Larry must take distributions over Larry's life expectancy because Larry's life expectancy is longer than Sandy's. Remember I said it's the longer of the two? So for years 1 through 9, he's going to take a distribution over Larry's life expectancy. But Larry must fully distribute the inherited IRA by year 10. So the question for the CPA is, okay, should we only take required minimum distributions, or should we take more than that? Because that could have an impact on the amount of taxes, right? Let's look at another example where the beneficiary is an eligible designated beneficiary. That's not a minor child and not the spouse of the account owner. Jim died at age 75. His beneficiary is his 80-year-old sister, Rose. Rose is not more than 10 years younger than Jim. Rose is an eligible designated beneficiary. Jim's life expectancy is 14.8 years. Rose's life expectancy is 11.2 years. Rose must take distributions over Jim's life expectancy because it's longer, but Rose must fully distribute the inherited IRA by the end of year 11, when she's 91, 11 years after Jim's death, when her life expectancy would be less than 1. Why is that? Because according to the proposed regulations, even though we're not using Rose's life expectancy, had we used it, it would have been less than 11 years later, right? So there was some confusion with the 10-year rule. I talked about that a few minutes ago. And we had been telling people, if you are a plain designated beneficiary, you don't need to take an RMD, even if the account owner died on or after the required beginning date. So now you might have clients who died in 2020 and didn't take an RMD in 2021, even though they inherited that account from someone who died on or after the required beginning date, because we told them that they didn't have to. So what should they do now that we have to go back to them and say, listen, because you inherited an IRA in 2020, you were supposed to start taking RMDs based on the applicable life expectancy in 2021. And because we tell you that you didn't have to, you didn't. So that means you now owe the IRS a 50% penalty on the amount that you should have taken, and you didn't. But the good news is the regulations and the tax code says that the 50% excise tax is waived if the deadline was missed due to reasonable cause. So that's part of the good news. Another part of the good news is that this affects a small percentage of your clients, only those who inherited retirement accounts in 2020 from someone who died on or after the required beginning date. Because those who died in inherited accounts in 2021, we still have time to explain to them that you really need to take an RMD if you inherited the account from someone who died on or after the required beginning date. And so the process is for the person to have their accountant file IRS Form 5329 to ask the IRS for a waiver of the excess accumulation penalty and include an explanation of why the deadline was missed and confirmation that the missed RMD has already been satisfied or steps have been taken to satisfy the RMD. And this is just repeating some of what I talked about earlier. Just because someone is eligible to take distributions over their life expectancy doesn't mean that that's the minimum they should take, because that's really a tax question. Taking the minimum satisfies the IRS requirement, but how does it affect the client from an income tax perspective? Now let's quickly go through the spouse beneficiary options. And I want to stop here and remind you that part of your benefit of having me on retainer is that you could say to me, Denise, you were going a mile a minute during that presentation, and I'm going to have to listen to it 10 times in order to get it. Or can you schedule a half-an-hour session with just my office so that you can answer our questions, right? And depending on the package you have, for everyone, you get this half-an-hour session. But if you're a gold client, then you get 1 hour sessions for twice a month. I need to go back to the terms, but I'll share that with you. But bottom line is, you don't need to feel overwhelmed as you're looking at these explanations. Just let me know if you want me to schedule a one-on-one presentation with just your office on one particular topic. For instance, we could say, let's talk about beneficiary options for spouse beneficiaries, because I don't want to be overwhelmed with all that different information. So one of the benefits of being a spouse beneficiary is that you get more flexibility with the distribution options. And that includes being able to move the inherited IRA to the spouse's own IRA. But in addition to that, the eligible designated beneficiary options apply, where the spouse beneficiary can choose a 10-year rule that we talked about. They can also choose a life expectancy rule, and I'm talking about when the account owner died before the required beginning date. But in that case, instead of distributions beginning December 31st of the year following the year of death, it can begin later, right? So it's the later of December 31st of the year following the year of death, or the year in which the decedent would have reached age 72. For distributions where the account owner died on or after the required beginning date, the distribution is taken over the longer of the remaining life expectancy of the decedent or the life expectancy of the spouse beneficiary. If the spouse beneficiary's life expectancy is being used, then life expectancy is recalculated, meaning you go to the table each year to figure out what the life expectancy is. But if the decedent's life expectancy is being used, you determine that life expectancy in the year of death, and you subtract 1 for each subsequent year. Now, why would a spouse beneficiary want to keep assets in a beneficiary IRA as opposed to moving into their own? Because that's one of the options. Because if they're under age 59 and a half, it helps them to avoid the 10% early distribution penalty. But how do they treat it as their own? Because that's one of the options too. The treat as own option can be effected by the spouse beneficiary redesignating the IRA in the spouse beneficiary's name. Most financial institutions accomplish that by transferring or journaling over the assets to the spouse beneficiary's own IRA, not taking beneficiary RMDs or making a regular contribution to the IRA, which most custodians do not allow. You can't make a regular contribution to a beneficiary IRA, but that's what the code says. Now, here's something that's changed. Before the proposed regulations, a spouse beneficiary could elect to treat an IRA as their own at any time. There was no deadline. Now the regulations are saying people are gaming the system. Let's change the rules. There's a deadline for a spouse beneficiary to elect to treat an inherited IRA as their own. And the deadline is the later of the calendar year in which a spouse reaches age 72 and the year that follows the year of the IRA owner's death. So now you're probably thinking, well, hang on a second. How is that going to affect my client when I've been telling them that, hey, they can elect to treat the IRA as their own at any time? But the issue is that people have been using that rule to game the system by telling spouse beneficiaries, keep it in a beneficiary IRA where you don't have to take an RMD, especially if the decedent would have reached age 72 at a much later period. And then when it comes to that time, move it to your own IRA where RMDs would be based on the uniform lifetime table instead of the single lifetime expectancy table. So that strategy was being used to minimize the distributions that could be taken by spouse beneficiaries. And unfortunately, because we talk about that a lot, Congress got wind of it and said, no, that won't work anymore. Now, if the account owner died before the required beginning date, the spouse has a deadline for treating the IRA as their own that I just talked about, but they can also roll over those assets to their own IRA. And there's no deadline on when they can roll over those assets. But guess what? Part of what the proposed regulations included, it says, oh, sure, you can roll over those assets at any time, but you cannot roll over any amount that would be considered an RMD if it had been in a beneficiary IRA where you chose to use a life expectancy method, right? So first you got to determine, well, let me first tell you how this usually works. The spouse chooses a 10-year rule, right? And so under the 10-year rule, they wouldn't take any distribution until a certain time, say when the beneficiary would have reached age 76. And at that time, then they roll over the assets to their own IRA. So they avoided taking RMDs for those first years, and then they move it to their own IRA. Now, the proposed regulations is saying, hang on a second. First, you got to determine what happened, what would have happened if you hadn't chosen the 10-year rule. Would you be required to take RMDs before the rollover? Then if so, you still got to take those RMDs, and the amount that you roll over cannot include those RMDs. So that bait and switch that we used to tell spouse beneficiaries that they could use to minimize distribution is no longer available. No more stretch IRAs. The stretch IRA strategy usually applies when a beneficiary is able to designate a beneficiary, called a successor beneficiary. Now, the terms of the IRA determines if that's available. In my experience, I've never seen one that does not allow a successor beneficiary. Now, under the Pre-Secure Act rules, when, let's say, an IRA owner died and the beneficiary was eligible to take distributions over a 50-year period, if that beneficiary died 10 years later, then the successor beneficiary, which is the beneficiary that inherits the account from the original beneficiary, would be able to continue taking distributions over the remaining 40-year period, right? But the rules have changed now. That was the pinnacle of the stretch. Now, the Secure Act and the proposed regulations say you can still do all that stretch distribution strategy if both the account owner and the primary beneficiary died before the effective date of the Secure Act. But if the account owner or the beneficiary died after 2019, then the rules have now changed. So if the account owner died and the beneficiary died before 2020, we look at the old rules. But if the account owner died after 2019, now we have to ask the question, is the beneficiary a plain designated beneficiary, which would be subject to the 10-year rule in most cases? Even when the life expectancy rule apply, you can't go beyond that. What's the option that's available to the successor beneficiary? Well, where the 10-year rule applies and the successor beneficiary inherits the account from that beneficiary that's subject to the 10-year rule, the only remaining period is what remains of the 10-year period. So they don't get a new 10-year period. If it's an eligible designated beneficiary, they would continue taking distributions over the life expectancy that was being used by the eligible designated beneficiary, but that cannot extend beyond 10 years after the year in which the eligible designated beneficiary dies. So you get one of those questions where a beneficiary inherited an account from another beneficiary. You just let me know and I'll make sure that you get the right answer. Some good news. Automatic waiver on excess accumulation penalty, where if an RMD is not taken by the deadline, a 50% excise tax is applied to the RMD shortfall. And this applies to both owners and beneficiaries. Now, the proposed regulations make some extension. For your clients whose first RMD year is this year, and if they miss the RMD deadline, then there's an automatic waiver under the proposed RMD regulation. So when your clients are supposed to take an RMD and they miss the RMD deadline, then we want to check to see whether or not it's the distribution for the first calendar year, because the idea is they're new to this RMD process. Well, maybe they forget, right? So even though this excise tax is generally owed for the year that the RMD should have been taken, now the new rule says, okay, you're age 72 this year, but your required beginning date is April 1 of next year. If you miss the excess accumulation, the deadline, the excess accumulation penalty would apply to next year, not this year. And here I include an example of what the old rules are. So at your convenience, you can just take some time and look at that. Here's another automatic waiver. If someone is subject to the life expectancy rule where the account owner died before the required beginning date, right? And they're an eligible designated beneficiary. So they're an eligible designated beneficiary, which means they can take life expectancy distributions, but they forgot or didn't take a life expectancy distribution for whatever reason. So now they owe the 50% excess accumulation penalty on the RMDs that they didn't take. The regulations carry over the rules, expanding the 5-year rule to the 10-year rule to say, listen, if you fully distribute the account by the end of the 10-year period, then there is an automatic waiver. So that's another good news. Now, I talked about the fact earlier that for the year of death, the beneficiary must take any RMD that the decedent should have taken but didn't take. There is an automatic waiver for that RMD if it's taken by tax filing due date plus extension of the beneficiary. Now, before the proposed RMD regulations, the deadline was December 31st of the year of death, which was unrealistic, especially if you have people who were dying at the end of the year. Now, if there are multiple designated beneficiaries, you want to check to see if any of those beneficiaries are designated beneficiaries versus eligible designated beneficiaries, because that might affect the distribution options that are available to them. Generally speaking, if all of them are designated beneficiaries, we know the same rule applies. But if some are eligible designated beneficiaries and some are plain designated beneficiaries, then the 10-year rule would apply. But with everything else, there are exceptions. So if you get one of those cases, please contact me. And again, I know I'm going a mile a minute, but there's a lot to cover. And the idea is that when you're done here, you don't remember everything, but there should be enough information. So when you do get that question, you remember that there's something that you should research further, or just send me an email or call me. And just a reminder, when you are trying to determine the distribution options that are available to the beneficiary, we need to know date of birth of account owner, date of death, date of birth of beneficiary, whether it's a surviving spouse, whether it's a beneficiary is disabled or chronically ill, and whether there are multiple beneficiaries. So here's what I'm going to do. I'm in the process of creating a beneficiary form where I'm going to send it to you as an intake sheet. So when a client comes in to see you and it's a question about an inherited account, you know exactly what to ask the client. So what are some of the action plans here? For clients that inherit retirement accounts after 2019, if you had already put in projections for stretched beneficiary distributions, then those have to be refigured. I believe in creating cheat sheets because they help you to get to the right answers. You don't have to do that because you're with me. So part of what I'm doing is creating a cheat sheet for every single category of beneficiary, so that when the client comes in to see you, you'll say, well, when you ask them those right questions and determine which category they fall into, you just pull out that sheet and that's all you would need to focus on. And I'm going to be sending you sample letters that you can use to notify clients of the changes, and be on the lookout for updates from the IRS and of course from me. Now, I know I filled up the hour, but over the next few weeks, I'm going to be doing more webinars just on particular sections of these RMD regulations. The next one is going to be strictly on plain designated beneficiaries. Once we get that out of the way, then I do eligible designated beneficiaries that are not spouses. Then I do eligible designated beneficiaries that are spouses and minor children. So just know that that's coming down the pike, and I'll keep you posted. And if you have any questions, if you want to stay back, I'll answer them. If not, please send me an email. Thank you for your time. I appreciate you. I don't see any questions. You can use the chat feature to submit your questions. I know there must be questions. So I am going to unmute to see if there's any question, if I can figure out how to do this. Okay, so you now have the option to unmute yourself if you'd prefer to chat by voice instead of type chatting.